Ladies and gentlemen, it is a pleasure to introduce Dan Fliman, Paul Hastings, to discuss his thoughts on recent developments in the credit markets. Just first, I guess, just tell me about your background and how you came here, and tell me more about yourself.
Sure. So I'm a partner in the restructuring group at Paul Hastings. We have about 110 lawyers internationally. And within our practice, we have different kind of disciplines, different specialty areas within the practice. We've got lawyers that are doing core restructuring, those that are doing distressed M&A, those that are doing debt finance, and those that are doing litigation. My practice tends to be a combination of the litigation aspect and restructuring practice, kind of like a juxtaposition between the two. My history leading up to that role was originally I spent most of my career at a litigation-oriented firm within the bankruptcy group, which really kind of gave me the background to do the juxtaposition between litigation and bankruptcy, which really means on a day-to-day basis is coming in, doing an analysis with respect to distressed issues, credit issues, bankruptcy issues. But rather than doing that analysis from the perspective of cutting a deal, it really is trying to figure out, well, what if things go south? What if there's a court filing? What if there's litigation? What if there's something contentious? And trying to anticipate how that will all play out.
Got it. And so, what kinds of things are you working on these days, and what's on your plate? What kind of developments have you been observing?
Yeah, I mean, I think what a lot of bankruptcy practitioners, restructuring practitioners, are spending time on right now is obviously LMEs, very, very topical. In particular, I think there's a real effort right now for investors to find opportunities to deploy capital into structures that they're not invested in right now. So LME activity for the last, 10 years or so has primarily been when there's new money raised, it's being done by existing lenders in the capital structure. That has a lot of utility and a lot of benefits because if you need any covenant relief under the documents to put in the money, you already have a group of lenders that have organized and are able to do that. But more and more lenders are identifying that there's an opportunity set and a way of making a profit by doing a deal from outside into a capital structure in which they're not currently invested. Now, historically, what has happened is that companies conduct a competitive process if they need to raise new money between the existing lenders and the people outside the capital structure. And historically, those deals ended up being done by existing lenders because of the benefits I just mentioned. As a result, for a long period of time, the market kind of dried up. Like nobody really was looking to deploy capital into structures that they weren't already invested on an LME basis. And a lot of the funds that really belong in this space just weren't deploying capital. More recently, what we've seen is companies that are okay giving exclusivity or even work fees to people outside the structure that are willing to come in and fund these LME transactions. And that's actually led to a lot of work for our group. On a day-to-day basis, we're spending a lot of time working with investors, trying to figure out how they can structure a deal, deploy that capital, and be opportunistic in connection with the structure.
How much has the advent of co-ops impacted that deal flow?
So it has a lot. The problem with co-ops have a lot of benefits without a doubt, but part of the problem with co-ops is when they get too large, like cross-class co-ops, you freeze the capital structure, right? You have an inability of the lenders to really be nimble enough in order to structure a transaction. You have inherent conflicts between the different tranches that sit within that co-op. And it's in these really large structures, we've got cross-class co-ops among, near-dated secured paper and long-dated unsecured paper. You got different dynamics and different motivations that there's more of an opportunity for somebody outside the structure to deploy capital and invest.
I mean, oftentimes that can cause causes of action or possible downsides. I mean, how do you factor that into the equation?
Yeah, I mean that's the analysis that we go through, and in particular that me and my team go through on the litigation side, which is somebody who's looking to put money into a capital structure. You got to figure out, number one, whether that money is going to immediately, when the moment it comes in, is going to trigger any kind of default on your credit agreements. So we're spending a lot of time with our finance team going through the indentures, going through the loan documents, trying to figure out whether a transaction can be implemented in a way that's going to avoid any defaults. That's table stakes. Right away you need to figure that out. Next thing you need to figure out is whether a transaction, the way you're structuring it, is going to have residual risk, like avoidance from like fraudulent conveyance and that kind of issue. And then you also have to start to think about things like breach of fiduciary duty. Now, while that's something that creates liability for the board, aiding and abetting breach of fiduciary duty is a real concern for somebody that comes in and deploys capital into a capital structure. The last thing you want to do is put in money only to find out that you've been sued because you've enabled a breach. So these are kind of some of the things that we go through pretty quickly when we're doing the analysis. And then you're thinking about things like, well, if there's a bankruptcy, what ends up happening? What impact does that have on the new money that you just invested? Are you going to maintain your seniority? Is there going to be a subordination type argument? And so these are all the things that kind of factor into the underwriting analysis that our clients are doing with guidance from their counsel.
Is it like sort of like you're kind of qualifying, like quantifying these risks as part of the underwriting process? Like how do you or just sort of you just lay out these are the risks, or do you quantify them?
Well, one of the struggles we always have is when we talk to investors, they always want to put a probability, exact percentage probability on whether a risk will actually materialize, right? They say, all right, well, pick the exact percentage of likelihood that this will actually be a problem, which is very difficult to do, right? Unless there's like binding established case law where we know the answer definitively, like we're otherwise really just trying to make an educated prediction based on where we think the litigation is going to be, how it's going to play out, and things like that. So most of the time what we're doing is we'll give some kind of indication like more likely than not, substantially likely, things like that, and then we leave it to the investors to kind of put that into quantified terms when they're modeling out the scenarios.
Because it could be sort of like guessing, like you have a 37% chance that someone's going to sue over this or something like that, right?
Yeah, we call it educated predictions, not guessing, but yeah.
Now, you've been in the restructuring industry for a long time, and you've seen the credit markets evolve over time. You've seen documents change. You've seen different rulings come down that have altered the landscape. Where do you think we are now in the evolution of LMEs? Like what's happening now?
Well, I mean, I think what you're referencing is that back in the day, many of us are old enough to remember that when you were in a broadly syndicated loan, you never really had adversity between the lenders that sat in the same loan. If you were a lender and you sat side by side with another lender, everybody got equal treatment. You never tried to pick anybody else's pocket. That was not really the case with indentures. Note holders have been trying to play games for a long time, but really if you sat in a loan, you really were pari with somebody, and that's the way it was. And that landscape changed, right? When it really primarily changed around CERTA, I would say, right, in 2020, where you had this idea that you have majority lenders. They come in and they rescue the company in an opportunistic way that makes a profit for them at the backs of the minority lenders. And I think that kind of changed the psyche, that changed the comfort level among lenders, and also in terms of the company willingness to take the risk and to deploy on a more aggressive transaction, which back in the day you never really saw public companies do and sponsors do, but over time that became a real possibility. So where are we now, to answer your question? I think we're in a phase right now where a lot of the structures deployed early on the LME phase have failed for one reason or another, whether it's a court ruling or because there's some economic reason that they're no longer there. A lot of the early LME structures have then been shut down in newer documents, right? So as we enter into new credit agreements or amend old credit agreements, we start to shut down a lot of the LME capabilities. But nonetheless, we as practitioners are always finding other ways in documents to structure a transaction when a company's in need of liquidity. I mean, that's just the reality. We sit down with the document, we try to figure out where else is there a place to make an argument that a transaction is viable and defensible at the end of the day.
So it's like the CERTA decision that kind of shut the door on open market purchase. Like, what new doors are you exploring? What new creative ideas are you contemplating?
Well, I mean, right, this shutdown, to the extent the document has exactly that phrasing. I think we've seen, like in the Mitel decision, that when the document is a little bit broader and doesn't necessarily require an open market purchase as the exception to the pro rata sharing provision, that those transactions can probably slide through. And I think that, that's really a way of accomplishing a transaction that doesn't necessarily share equally among all the lenders. There's also the whole different concept of a transaction that is beneficial to the company but not beneficial to any of the existing lenders, right? And that's where you may do a drop down, or more recently, we've seen the idea of a non-subsidiary come into a structure, which people are spending a lot of time kind of thinking about. So there's a bunch of different angles that people are contemplating right now, trying to get around existing decisions that have shut down some of the doors.
I think what you're talking about is like specially created subsidiaries for this purpose, right?
Right.
I mean, what's the new frontier in that? Like, I mean,
so listen, the idea of having a subsidiary that you put value into has kind of like two limitations on it. Number one is, does the document allow it, right? Do you have a covenant breach if you do it? The second is there's a business issue, which is, do you have a discrete asset you can move into another entity that doesn't disturb the ongoing operations of the company? We've seen that happen with IP going back to J. Crew, because IP is like a pretty easy thing to move, but you can't really move like a manufacturing facility. You can't really move, a contractual relationship without too much disturbance. So those are the two things that go into the idea of like moving assets and then borrowing against them.
in Xerox, wasn't there a new, interesting, and sort of as of yet unproven workaround? What do you think about that?
So it's a case I'm working on, so I'm not going to comment on that. But just to kind of walk through what actually happened there, the IP was located at the public entity, at the Xerox Corporation. A lender came in, and after the IP was basically placed into an entity that was structured as a JV. The JV voting rights are 49% owned by Xerox, 51% owned by this investor. And the reason that they tried to do this is because the definition of subsidiary in a document is a very nuanced, specific definition. And that definition is basically that a subsidiary is an entity that has majority voting control by Xerox. And so with 49% voting control retained by Xerox, 51% voting control going to this investor, the argument that the company is making is that it is no longer a subsidiary. Now, the implications of that, if that works, is that loan agreements spend a lot of time talking about what happens with a restricted subsidiary, what happens with an unrestricted subsidiary, but there's virtually no limitations of what you could do with an entity that is not a subsidiary at all. And so that's why that is a creative read of the documents that may or may not work, but that's kind of like the first time that that's been attempted in a large public situation.
I mean, it'll probably be litigated, I'm guessing, but I guess we'll have to see, right? But it's at least it's worth a shot, right?
We'll have to see, and as we were talking about before, one of the realities with all these LME situations that litigating them takes years, right? If you bring a lawsuit today in connection with an LME situation, you're not going to be able to get any kind of vindication for like 2 years, right? If you kind of think about the life cycle of a litigation and motion practice and all this and that, and it's going to be millions of dollars most likely, and you're going to be up against a well-funded adversary. And so that creates a really complicating transaction when a transaction, when something launches that you're on the outside of, and you need to kind of think about how long and how much it's going to take in order to try to undo it.
I think you mentioned there's a new concept being floated of shifting preferred equity into a new sub. Tell us about that.
So this is something that we've been getting calls about recently, which is a concern in the market that sponsors really being in a bad spot in a lot of transactions, a lot of structures, but holding pref in those transactions, or those structures rather, will try to engineer a transaction where basically they drop assets into a subsidiary, and that subsidiary issues debt, all assuming that it's allowed by the documents. But then the next thing that would happen, which would be really kind of a new development in the market that we've never seen somebody actually accomplish, is the sponsor holding pref at the holding company would exchange their pref for newly issued senior secured debt that's structurally senior to the existing lenders. And that has a lot of implications from the fiduciary duty perspective, from the fraudulent conveyance perspective. But if you can check the box and say that it is consistent with the loan documents and you remove the risk of an event of default, it's something that might actually be very interesting for a sponsor to at least try, right? To your point, why not try it if it takes a long time for somebody to undo it? And so each situation is very specific, but if you're a sponsor and you're sitting there with a large loss in your position and a pref piece, it's something that you're now thinking about. And as I said, like, we've been getting a bunch of phone calls recently of either existing lenders or sponsors thinking, should we try it or should we defend against it?
But to explain, how would the pref sit in relation to the secured debt exactly?
The idea would be that at the end of the day, the sponsor no longer has pref. They actually have secured paper. The entity that received the assets, that subsidiary, actually will be the owner of the pref piece.
I see. So it's like the box owns the pref. The sponsor owns the debt, right?
That's right.
But this is another unproven, untested,
Right.
new concept that the innovators in this market, like yourself, are thinking of, right?
It's a structure that we have not seen deployed, at least not on a public basis. A lot of this is private, right? So you don't actually know if these transactions close unless they become public because of good reporting, right? But we're not aware of it happening in any situation yet.
And this would be for if there's a sponsor with a distressed portfolio company that wants to hang on or avoid a write-down as long as they can.
That's exactly right. That's exactly right, yeah.
Let's talk briefly about just the rise of private credit as an asset class. And, it hasn't really sort of seeped into the restructuring space in the way that I thought it would, but do you think it will? And are we going to see more private credit restructurings going forward, do you think, or what?
I think it's too early to really predict. I think what we're seeing in private credit is, if you back up, the way I was kind of describing the development on LMEs, where you basically had lenders who were always okay sharing with each other and nobody was trying to pick each other's pocket. That's still what you're seeing in the private credit deals, right? They're clubby deals. Everybody's kind of like repeat players. They all work very well together. And you really don't have any situations that we've really seen where one lender's trying to, do a majority transaction, steal value from another private credit lender. Now that may change, and it only takes one situation like CERTA for the mentality of the lenders to change, but so far it hasn't. Rather, what we've been seeing is a real willingness to extend covenant relief among the private credit lenders, give additional relief to the company, in particular where there's a sponsor relationship. So the question is, where is this all going to go, right? Is part of the LME work and LME kind of philosophy that really is now all across the broadly syndicated loans, is that going to seep its way on a more definitive basis with like lender on lender violence in the private credit space? And it's still too early to tell.
And I think you've probably seen the headlines that there's been a lot of redemption requests from the LPs in some of these private credit funds.
Yep.
Do you see that kind of putting pressure on how these lenders handle the actual companies themselves that they have positions in?
It may, because I think that as individual lenders start to suffer a lot more pressure in order to bring in a recovery, their willingness to give further relief and further extensions to the company, might shrink.
Okay, so I think there's going to be some interesting developments to come, and
so.
Dan Fliman is at the cutting edge of this stuff, and so it's been great talking with you. We have another panel coming up.
All right, thanks, Alex. I really appreciate it.
Yeah. Well, it was great. It was great.
Thank you. Yeah.
All right.